This lesson in the price action series is going to take the Wyckoff theory and apply it in context of Wyckoff events. So by now you know what Wyckoff theory is, you know the three laws of Wyckoff, you've seen the schematics of accumulation distribution, you understand the core principles of the theory, and you will have seen along the way some annotations on the charts, usually two letters, things like BC or UT or UTAD or ST. And of course, I'd imagine that you are confused about them. So in this lesson, we're going to cover the different events that happen and occur within the different phases of Wyckoff theory. Wyckoff theory has stood the test of time because it relies on logical price action principles, and it focuses on specific repeated patterns of behavior that we can use to estimate with high probability which side of the market is in control. So using Wyckoff principles, we can say, are the bears in control or are the bulls in control? These patterns of behavior are known as events. And there are 7 events within Wyckoff theory. Nothing exists for no reason. So in this lesson, we're going to talk about these events, why they form and what they actually mean, both on a psychological basis of the traders who create them and as they're expressed on the chart through price. So in order, we have preliminary stop, we have a climax, we have reaction, we have the test, we have false breakout, we have a breakout, and then we have confirmation. So as we go through the charts with the schematics, you'll see each of those explained. So I'll look at it first in accumulation, and then we'll briefly skim back through it for distribution. But you know that it's the same principle, just inversed for tops and bottoms. So the first sign of buyers or sellers coming in is what's known as the preliminary stop. This is the part here. So the PS. Preliminary stop, also known as the preliminary support in accumulation or the preliminary supply in distribution, shows the first sign that buyers are stepping in. You will see volume increase, and an important way to view this is that it will look like a bottom or a top to most people. So in accumulation, the time that you think it's the bottom is usually the preliminary stop, right? It's supposed to look like a bottom because that creates the squeeze potential to push price down and trap the early longs or, on the distribution, the early shorts. Right, so keep that in mind. Keep that specifically what I said about it. It's supposed to look like a bottom. This alone could revolutionize your trading if you just listen to this one part. Of course, you should listen to it all. The part that looks like a bottom is more often than not the preliminary stop. It's like you are correct, you're just slightly early. We then move through, still in phase A. So this, the preliminary stop obviously is the beginning of phase A. And we move through to the climax. The climax is where price pushes down through the preliminary stop. So it goes all the way through the stop and right down into the bottom. It happens this way because those who thought that the PS was the bottom went long and now they're getting stopped. They're getting stopped out. Usually this is violent and it makes people fearful of continuation, which is exactly as it is planned by the smart money, and it's why the move ends there. It's a combination of early trader capitulation and disbelief, right? So a very common example would be a big red candle in a downtrend, a huge red candle of capitulation, of stop losses firing, everyone's screaming, everyone's wondering what's happened, they're expecting the market to go lower, they're fearful, the typical feeling you have. That's the climax of the move, also known as a selling climax in a downtrend or a buying climax in an uptrend. Sometimes though, it's not violent and it can top or bottom on a lack of interest, which has the same desired effect. So the most important thing is that you push below the PS, and then if you get a big capitulation, a big red candle in this case, then great. But also, if it hangs around below that PS level with a lack of interest and starts to turn in the opposite direction, that can be the bottom as well. What is the desired effect? It doesn't feel like a bottom, okay? That's your key. The preliminary stop will feel like a bottom. It may induce you to go long. Then it will go lower and stop you out, and then you won't feel like longing, when in fact that is the bottom. Understand? Every one of you watching this has been through this, as have I. This is basic market psychology. The first time, and it comes down a little bit into ego and a little bit into fear, you first see what you think is a bottom and you long it. You then get stopped out, and because you get stopped out, you're a combination of your ego's bruised and you're a little bit salty, and you're fearful because you think it might go lower, and you don't want to be wrong again, so you don't long the second time. But the second time is actually more likely than not to be the bottom. So the key difference, preliminary stop, feels and looks like a bottom, but it isn't. The selling climax, after everyone gets wrecked between them, doesn't feel or look like a bottom, and it always comes with people saying this is going to go lower. So either you have the big violent crash and everyone says that was so big and violent that it's going to keep crashing, or you have the lack of interest where it just grinds down. And the same thing, people say, we haven't had a big violent crash yet, therefore it's going to go lower. You notice how both of those get the same desired effect. So be on the lookout for both. It doesn't always have to be a big spike down or up. It can sometimes just bottom or top on lack of interest. Third, still in phase A, we're looking at the automatic reaction, the reaction. We're in the reaction phase now. We're still in phase A, and a lot happens in phase A, as you can tell. Phase A is the most important. It develops the entire structure for this accumulation or distribution. But the reaction is your first big sign from the market of a trend shift. Usually, this is where the last leg of the trend retraces 75% or more. So you know from previous lessons where I've talked about trend following, that trends to continue generally shouldn't see a pullback past the 0.618 fib level. So the reaction is your clue to this. It goes from control of the bulls to balance, or control of the bears to balance. Let me make that clear. When you're downtrending, like here and here and here, your bounces are relatively shallow because it's a trend. So it shouldn't bounce super high. Then when you get that first strong bounce that goes almost up as far as the high, doesn't have to go right up to it, almost up to it, that's what you consider to be your reaction, automatic rally, or automatic reaction, depending on whether it's bullish or bearish. And this is your sign, this is your clue that control is moving from, in this instance, from control of the bears back to a point of balance. The important part here of what I said, number 3, the reaction, it is not, I'll stress this is not where control goes from the bears to the bulls. This is where control goes from the bears to being neutral. The market goes into balance because all of this that is to come after is not guaranteed to be accumulation until the end. It simply means the bears are no longer in control and we go into sideways consolidation. Next we have the test, also known as a secondary test, ST. And as the name suggests, this is the point after the reaction where we test the commitment of the previous trend. So you're understanding, you can see now how this develops in the minds of actual traders. We had our selling climax, so we had our big capitulation or our low interest bottom. We then got a strong reaction. And so after the strong reaction, people are going to be thinking, oh, are the bears starting to lose control? How do you find out if the bears are starting to lose control? You have a test. So you push back down towards the low and you see, are we going to create a higher low or are we going to go right down through it and go lower? So what we're looking for here is how do the bulls or bears act at the secondary test? The secondary test, the ST itself, is, as the name would suggest, the second one. So you have the low and then you have the second attempt. But tests themselves can continue all throughout phase B because after this one, after the ST, this is when you move into phase B. So after that, we now move into phase B. Okay? We've covered the phases before. We're just looking into the events now. So you've seen the phases in previous lessons. This now gives a little bit more context to them. The tests can continue all the way throughout phase B, and sometimes they look like a false breakout. Other times they're just regular tests. In this example on the screen for the accumulation, the test shows up as a show of weakness, SOW, shows up as a false breakout. That is a valid test. But also, if price had have come down and not gone below the orange line and reversed, that would also be a test. This is the choppiest part of the entire structure, and so you can expect many tests. Quite often there are several tests. It's not a very clean period of price action because the very nature of it is it's the most indecisive time in the entire structure. At the beginning, in phase A, we have a nice strong trend. We then have some reactions. We have a lot of very technical movements. But when you start moving into phase B, the market gets really choppy. So don't be worried about it. Don't get trapped by it. It's fine. It's just part of it. It's the market doing what it needs to do. And all the way through phase B, the only thing you're really going to see on both the downside and the upside are tests. Once you get what's known as the false breakout, that's when you know you're in phase C. So the false breakout is self-explanatory, but also I've covered it in depth in its own lessons. False breakout, viewed through the lens of this distribution schematic or accumulation schematic, is the same as the actual lesson I've taught about any false breakout. It's simply where price moves above a high or below a low and then reverses. It's a false breakout. It's a fake out. It's a trap. It's a sweep, whatever you want to call it. This is a trap to engineer liquidity by smart money. And often, this is important, it just starts out as a test. It doesn't always have to be perfectly planned and manipulated. Often it just starts out as price testing whether to go lower. And if the bulls or bears don't have enough commitment, they'll get trapped and it will signal a probable shift. Okay, so the false breakout, phase C. On these schematics, you can either have it as the spring in Wyckoff, sweep, as I like to call it, whatever you want to call it. And sometimes, remember this, sometimes it will just be a final test. You don't always get the false breakout. You don't always get that part, that event. Sometimes the market just keeps defending a specific low or specific high. But of course you understand that by now. You understand that not every accumulation is supposed to look like what's on the screen and that there is nuance to it. That's why we talk in phases. That's why we talk in events and we talk in structures. You're looking more so at time and what price is trying to do rather than waiting dogmatically on a very specific schematic to form. Then we move to the next event, the sixth event, which is the breakout, and which brings us into phase D of Wyckoff. So the breakout, as the name would suggest, is where price breaks out. It's a very specific part. It's literally just the candle or multiple candles that do the actual breakout, which closes above the previous highs of the range. This is the most important part, and this is an area where there are many false moves as well. So by this point, the market is fairly sure that we are in accumulation and that we're going to go higher. But the market has to be fully ready for the new trend. The sellers in this case must be demoralized and ready to give up. So it takes a lot of commitment here, hence why it can take a few tries. Sometimes, when it goes to break out of range, it fails a couple of times. That will trap some early buyers, and it will create some liquidity to fuel the smart money to load their bags up. Also, sellers need to give up as much as buyers need to be aggressive here. Whenever sellers finally say, oh, screw this, I know it's accumulation, I give up. That is when you get that strong move through that doesn't come back. Okay? And then that leads us, of course, into the final event, number 7, confirmation. And confirmation comes from a retest. Or, there's a few ways it can come, but it comes from a retest or volume. And the important way to spot this, to actually spot it on your charts, so a breakout's easy to spot. It's whenever, whatever time frame you're looking at, there is a strong close above the previous range high. That's a breakout. Your retest, much the same, should come back to the breakout level and not close below it. And if it doesn't even get right to the retest level, that's also a strong sign. And what you want to see as well is volume supporting that. So, like we've said in other lessons, volume on the breakout should be high, much higher than average. And then when you go to retest, the volume should be much lower. There should not be much interest at the retest. Remember what I said in event 6? Sellers, in this case, for accumulation, sellers should have given up. Sellers should be losing interest. So there should not be high volume on the retest. And if the market is positioned right, solid support will flow in here. So price will move very slowly. It will not shoot back down into range because sellers are disinterested and buyers, knowing that it's accumulation, are stacking up their orders trying to get long. Purely from price action, you'll remember the lessons on impulse and correction, the nature of a trend. That matters here because what is the confirmation? The confirmation is the beginning of the new trend, in this case, uptrend. If it's the beginning of an uptrend, then you know that there should be an impulse, a strong move up, and a correction, which is a weak move down. So it moves down, but it moves down slowly and without impulse. So keep that in mind. Retest, volume confluence, and the shape, the nature of the price action being impulse and correction. You want to see a corrective move into the retest. You do not want to see price impulsing into the retest. That quite often is a sign of trap traders and that the fact that it's not actually going to be a breakout. So that's it. That's 1 to 7 on the events for accumulation. Quickly looking through distribution, the exact same thing. Here you have a preliminary supply, which is the same as preliminary support, and as known as the preliminary stop, as a general rule. Phase A of distribution, it's the first sign of sellers coming in. Okay, volume will also pick up. It will look like a top. Catches most people out. This is exactly where people get short. And you probably see this, it probably feels more natural to you on the upside than the downside. Because how many times have you looked at something and said, oh, that looks like a top, and then boom, it busts higher. Very, very common, especially in crypto. Second, you have the climax. Blow off top, it's also known as euphoria, whatever you want to call it. That's the part where everyone thinks it's going to go higher and they're afraid to short. They were happy to short at the PSY, now they're afraid to short. Again, capitulation from bears and disbelief. Third is your reaction. This is where people go into denial. So especially at a top, because everyone in crypto wants to be long, you have what in hindsight looks like a really clear show of weakness, a big sell-off, almost fully retracing the impulse from before. But everyone turns around and finds reason to say that wasn't the top, this is just a cool-off, it's healthy, whatever. That is your reaction. That is your first sign. The first big sign from the market of a trend shift. Then you have your ST, your secondary test. And this is the end of phase A in distribution. We then move into phase B, and we have more tests, shows of weakness here, testing of the support level here, and we can even have upthrusts as tests. Upthrusts in a distribution, you can have multiple of them. They are testing for liquidity. So it happens on both sides all the way throughout phase B until you get to phase C, which is your big false breakout. So we get that, we get our upthrust after distribution, we then fall back, we have a test, and then we move into phase D, and we weaken down to the lows, and then we have the breakout. We have event number 6, breakout. We have the confirmation with usually a major show of weakness, with a bounce back up, volume confluence, corrective moves, and then impulse lower. Again, if the market is positioned right by this point, buyers will have given up. There will be stacked offers above, so heavy sell walls above at each point, and the market will just keep stepping down. It's now time to finish the structure and move down and find into a new trend and then find a new low to create some accumulation. So that's it. Those are the Wyckoff events: preliminary stop, climax, reaction, test, false breakout, breakout, and confirmation. In the next lesson, we're going to break down each of them in depth to show you how to actually trade or use them to identify in real time on the charts. So go through, we'll look at one of those.